Hello everybody and welcome to Confident Compounding with Corey Kramer. Today we're going to be analyzing Target stock. This one came in by request a while back down in the comments of one of my other videos. If you have a request you'd like me to take a look at, put it down in the comments. I'll get the ticker on the chalkboard behind me that looks fuller than it really is because I've crossed off a lot of those. I went through today and I think I got back with everybody that asked for a request or commented in the past week. So I should be caught up on all those. And if I don't post them here on YouTube, a lot of these smaller companies I'm going to be posting on my free tier over on Patreon. So make sure to check out that link down in the description. And I have weekly picks for $25 a month over on Patreon too. Let's see. As always, it's not individual investing advice, just how I analyze stocks. So Target today announced, I think they announced earnings today too, but stock price down. It doesn't show on the fast graph until later tonight, but it's down about 7 or 8% today. News, the CEO is stepping down, being replaced by another insider at Target. So I've covered this one in the past. It's kind of interesting. I don't know. For being so boring, it's let's just say it's more interesting than it should be. So if we go over on Seeking Alpha, back in the day, I wrote a few articles on Target. So this one in 2018, which I compared to TJX, was actually a buy for TJX and not Target. Which marks on here because they put them both together. Just an interesting side note that popped into my head. I think I put that out like the Easter weekend or something like that, and it was the least read article I think I had the entire year, and I wrote like 100 articles that year, so probably nobody even read that one back in 2018. But the main one I want to point out here is this 2019 November 18th article, where this is just a simple valuation analysis, where I had a sell rating on Target, and this is pretty much before any of the kind of various controversies that have popped up over the years happened. So, I had a sell rating on Target before it was fashionable on the internet. And then in 2022, I kind of used it as an example of the boom bust. That's what this article here was all about. So just to kind of show you where I was. So this is back during this kind of November-ish. I think it was the 18th, but this is like weekly. So since then, the stock's basically flat. You would have gotten a 2% dividend, less than inflation. So now, what's important to point out is, and somebody will certainly point out in the comments, well, if you would have bought here and sold at the peak of the pandemic boom, you could have doubled your money, which is absolutely true. But that article was written before the pandemic started, right? And before all the stimulus and before all that. So it was a valuation based on the previous historical trend that had been leading into, which is what I always start with. And then I use kind of reasoning and common sense, and just human faculties to go beyond what the history has shown and kind of layer that in. But I always start with like, what has it been doing? And that's probably going to be kind of a baseline for the future, unless there's some obvious reason why it wouldn't be. And so this is kind of what it looked like before then, not including buybacks, which I did a bunch of. They had about 7 or 8% growth. But often I would start this a little farther, like right there. When you do that, they only have a 5.5% earnings growth rate, not including the declines here and the decline here. So even during this period, they were only growing earnings. Now, granted, we had a bad recession during this time, but they're probably only growing earnings 3% a year in a 1% inflation environment, right? So a couple points above inflation is all they were doing. Basically a mature company at this point. And whenever I decided that I didn't really decide, I just did the math, right? I mean, they were expensive. I think they were trading close to a 20 PE. So a 20 PE with, if we generously call it 4% real earnings growth, PEG ratio of 5, right? I mean, that's just very expensive. Over the long term, unless that trend breaks, you're not going to get good returns most of the time. Okay, so fast forward to the pandemic. Let's shorten this a little bit. I do have a 25% off affiliate link for Fast Graphs down in the description. If you guys ever want to try it out, make sure to use that link and get yourself a discount. Okay, let's see here. So we have these big, huge earnings years because of all the stimulus from the pandemic. Target did a pretty good job with their online presence and availability and just adjusting to the pandemic. And so they had this boom period, which whenever I wrote that article in 2022, I think it was after it started to come down, and I was warning people that it could happen to other stocks, which it did. We should have expected this kind of pullback because all the stuff was pulled forward. People spent a bunch of money on goods rather than services and all that kind of stuff that we know about. And they had a bunch of extra money from stimulus money. So this bust was predictable, but the question is like, what happens after that, right? So they had earnings start to rebound, and that was good and kind of what should have happened. But then what happens is they start to kind of roll over the past couple years, especially this year. So when I look at the numbers here, one of the things I'm going to look at is 3-year revenue trend, which is going to be negative now. But I gave them a break on that because for the past couple years, if you go back 3 years, your starting point, you're in the boom, so you're probably not going to be able to keep that rate up. So while I was cautious, I wanted to be fair to them because earnings did bounce back, and once they get far enough in the future, maybe they start using like these 2023 earnings, right, or revenues as the base for their growth, potential growth. That's more fair than going back to 2022 or 2021. And that's one of the metrics I watch for deteriorating, kind of competitive deterioration. So competition is taking money, taking shares, or customer preferences are changing, right? That can do that too. So I don't want to buy businesses when they're tilting negative on that, right? So we're going to talk about that in a moment. But just generally speaking, I think Target is a good, very basic kind of proxy for like the middle class in America. And you can see that it pretty much follows kind of how the middle class is doing. They have a lot of discretionary items at Target that are a little nicer than the stuff you'll find at Walmart or a dollar store. Or now we bought Dollar General and it's doing really good. So we see the low end, like you can kind of see that deterioration happening, where people are, at least some people in the middle class, are trading down to more kind of working class prices, like stores. But if you go back to just before the Great Recession, now leading up to this, Target had fantastic growth. From the 70s on, Target they were really crushing it, really great growth. I'd say it peaked right before the Great Recession. And if you look at like the returns here, they're only returning 4% a year, probably a 2% inflation environment on average. So again, a couple hundred basis points above inflation per year. That's about what the economy's done in the US. So this is one of those things that I just kind of log in the back of my mind when I'm thinking about other things sometimes. It's just one data point, so I don't do anything with it really. But I think it's worth paying attention to, because when we had all the stimulus and everything and GDP was rocking, Target was rocking too. And now there's going to be some debate here in the next year about how the economy is really doing. And what we see with Target is weakness. So that's just kind of like I said, it's just a data point to kind of put, in the back of your mind when you're trying to figure out what's really happening, what's really happening in the kind of middle class economy, right? Wealthier people, not such a big factor for Target. So let's get into the spreadsheet here real quick. I'm going to show you kind of, this is a little more big picture than some of my normal videos, which I have other videos on Target. I made one each year the past couple of years. You can go back and watch those if you want to look at the valuation video. So here's the deal. I just updated these numbers, and you can see a lot of red and yellow, which is not usually good. So this red number here is the cumulative 3-year revenue, right? So what were revenues 3 years ago compared to what they are now? They're down 2.61%. And that's in an inflation environment that's probably like 4% over that time. So it's even worse than that. It should be, just to keep up with inflation, they probably needed to do 12, 13, 14%, and they're down 3. That's cumulative, not year by year. So that's really bad. And like I talked about earlier, at first I would have given them kind of a break on that because we know we're coming off the boom. But I think we're past that now. This is basically going back to almost 2023, almost like getting into the very end of 2022. And even the more recent numbers are weaker. So it's not like there's like a light at the end of the tunnel. Typically, if I own a stock and there's not extraordinary circumstances like with the pandemic or with a recession, and this 3-year revenue number goes negative, I sell. So... And I think after this quarter, if I own Target, maybe if I try to pick one of these bottom, I don't know if we had a bottom back here. A little bit of one, maybe I tried to buy it back in April or something. And it got a little bit close because I noted in so sometimes when these get close to buys, this will automatically switch if you're a member of the Cyclical Investors Club or Confident Compounding on Patreon. You get access to the spreadsheet. So this will automatically flip to a current buy if all the metrics are met. But sometimes if I get I want to be a little bit more careful. I'll put currently monitoring so it doesn't automatically switch before I get a chance to look at it, just to review it one last time. So you can tell that I was already kind of not sure if this was something I would want to dip my toes in, even if it hit that $77 level, right? So now after this wasn't as bad then, and the earnings growth I had 4.99%. So all these have gotten worse. They bought back a lot of shares the past 10 years. Those have turned out to be, I want to say they bought back a quarter of the company in 10 years. Given where the stock price is right now relative to back then, I would say those are horrible investments. So, because that means and usually these companies just kind of buy a similar amount like each quarter. So for the past, since I said it was overvalued in 2019, 6 years ago, for the past 6 years, they've been investing in their own company when it was overvalued. And those they've been buying their stock all this time, and it's all been bad. So the CEO deserves to get fired for that, over a long period of time. I don't get into like the politics of it. I know people get testy when it comes to Target. I don't really care about any of that, but I've always thought their CEO was a little overrated from the very beginning, mostly from like being on the Kramer show, the other Kramer. He always hyped him up so much back in the day. And I was like, I don't really see anything like special that he's doing, but that's his show or whatever. So, when you take into account those buybacks, real earnings growth has only been 1.58% during this 10-year time period. On the fast graph, it's at 4.45. That doesn't take into account buybacks. So it's bad. Like that's just below even inflation. It's not even close to being good. So when I put all these new things together, it's actually overvalued still enough to sell based on evaluation if it continues with this kind of earnings growth. Even if it was like 2 or 3%, it would still probably be overvalued. So when I get something like this, then I go in and I just take my buy price off, take that one, and then I write a little, like this one I said, I want to think about it, blah, blah, blah. If it hits, I'm just going to say, revenue, and if I can spell, revenue and earnings growth is too slow. Boom. Okay. So now I don't have to worry about, even if the price falls, this switching to a buy. The quality is not good enough for me to buy. It doesn't meet my basic quality standards anymore. My basic quality standard is they need to be able to grow earnings faster than inflation over the medium term. So Yeah, 1 point whatever percent isn't doing it. And you can even look pre-pandemic at $6.39, and they're only going to earn $7.25 this year if nothing else bad happens, and a 20% inflation that we've had since then. So even just looking directly pre-pandemic to today, forgetting about all the boom bust and stuff that's happened, business is slowing down. The earnings are slowing down. And so, you know, this is part of the life cycle of these businesses. They could come back. Heard somebody talking on Bloomberg today about American Eagle having a giant comeback. I don't bet on those type of comebacks, which means occasionally you'll miss like a big one, which is fine with me, because I know 9 out of 10 times they're not going to make me money, and it's not worth it to try to get the 1 out of 10. Probably worse than 1 out of, it's like 1 out of 50 or something, that will produce like a 10 bag or something when you pick it up off. Maybe we'll look at American Eagle. I don't know if it's on here or not. Every now and then somebody asks me, oh yeah, American Eagle Outfitters. So let's look. Well, this one's been very cyclical the whole time, right? But if you picked it up right here, I don't know why they were saying it was such a comeback. I mean, that's a double, but I guess maybe this is the beginning of a new comeback. I don't know. It doesn't even look that good to me right now. So yeah, that's why I don't that's why I don't try to do it. All right, I think that's it for Target. Not high enough quality. I would just stay away from this one. Try to find something. I mean, I own Dollar General's not still a buy, but that's an example of an established company that got beat down. Maybe I'll just look at it real quick. I have video on it. I have a buy video actually. So this is what this one looks like. So they had the boom, they had the bust. We took some positions back here. It's up like 40%. And if earnings flatten out and more people kind of trade down and they kind of increase their efficiency in their business, which is what they need to do, if these earnings come back, we should be able to get a nice little 50% return in a, I mean, I like to do it within 3 years, but this will probably happen within a year if it keeps going, if they don't screw things up. And, you know, and that's all right. You can make a little bit of money sometimes with these established businesses when they go through a rough period. But I think Target's thing is worse than that. I mean, if I went back to, I showed you the 2006 Target period, like, we do the same thing with Dollar General as far back as we can go, 2010. It's up almost 500%, right? So they've been growing this whole time, and Target hasn't grown at all, basically. Okay. If you found this useful, hit the like and subscribe button. Consider the free tier over on Patreon. Put your requests down in the comments. I will eventually answer all of those unless somehow they sneak through my filter and I don't see them. But lately it's been taking me like a week to get back. I'm going to try to improve that to a few days. But yeah, you'll get a comment back from me, even if it's just thanks for commenting. All right, everybody. See you later.